If you own investment property and are thinking about selling it and purchasing more property, you should know about the 1031 tax-deferred exchange. Now, there are several types of 1031 exchanges, and the process is different for all of them. Today, we're going to be discussing the most common type of 1031 exchange, which is referred to as a delayed exchange. Now, the 1031 is a procedure that allows the owner of investment property to sell it and buy like-kind property while deferring the capital gains tax. Capital gains tax rates on most assets that are held for less than a year should correspond to ordinary income tax brackets, and long-term cap gains will cap out at 20% depending on how much the gain is. If you're an investor, it's typically ideal to defer the tax as long as you can so you can acquire more and bigger assets now in the present so that they can grow, appreciate, and cash flow in your pocket now while the dollar is worth more versus later. A delayed exchange is when you sell a property or properties that you own and a replacement property is purchased within 180 days. And the replacement property, which we'll talk about in a little bit, must be identified within 45 days after the close of escrow. Proceeds from the sale must be transferred to what's called a QI, or qualified intermediary, rather than the seller of the property, and then the QI transfers them to the seller of the replacement property or properties. Now, for that reason, the first step is, of course, to get with your agent, discuss that this is something that you want to do or explore, but then you need to get with a QI first. They're the person or company that agrees to facilitate the 1031 exchange by holding the funds involved in the transaction until they can be transferred to the seller of the replacement property. So they sort of act similar to an escrow company in a typical real estate transaction. As an investor, there are a number of reasons why you may consider a 1031 exchange. So what we're going to do is go through three of the main ones right now. But keep in mind that the main benefit is the tax deferral itself. So number one, you may just be seeking a property that will give you a better return. Number two, you might want to consolidate several properties into one for the purposes of estate planning, or you might want to divide a single property into several assets and diversify. And then number three is reset the depreciation clock. Depreciation is a percentage of the cost of an investment property that is written off every year regarding the effects of wear and tear. Now, of course, this is just a paper loss. It's an incredible accounting tool for maximizing your return. So not many people realize this, but when you sell a property that you've continued to take a depreciation deduction on, you're required to pay back a portion of that, what's called depreciation recapture. So Uncle Sam is going to get his too, but luckily this is capped at 25%, which is typically less than what your income bracket would be, both federal and state combined. And remember that the depreciation deduction is just a paper loss anyway, so any little bit helps regardless of the recapture tax. Even with that being said, what makes a 1031 exchange even that much better is that your depreciation recapture tax can be deferred as well, just like capital gains. So we're going to finish up by talking a little bit about choosing a replacement property and what goes into that. The exchanges must be of like kind, right? Which is kind of like this enigmatic phrase that doesn't necessarily mean what you think it does, right? You can exchange an apartment building for raw land, or let's say a ranch for a strip mall. So the rules are pretty liberal. The replacement property must be held for investment purposes, so not for resale or for personal use. And next, these are some of the basic rules, and there's a lot of them, that go hand in hand with identifying your replacement property. They have what's called the 3 property rule, which allows you to identify 3 different properties as potential purchases regardless of their market value. There's also the 200% rule, which allows you to identify unlimited replacement properties as long as the cumulative value doesn't exceed 200% of the value of the property sold. The replacement property or properties need to be of greater or equal value to the one that you're selling. And then there's also the same taxpayer rule, which means that the tax return and the name appearing on title of the property being sold must be the same as the tax return and title holder that buys the new property. So much to digest here. Watch this video again if you have to. If you have any questions about 1031 exchanges or any of the other terms that I talked about today, you know what to do. Reach out to me directly. I will help you to the best of my ability, and that includes connecting you with a QI, qualified intermediary, if you need one. See you on the next video.